Hey guys, it's CJ Investing here. Welcome back to my channel. And today I'll be doing a short video on just talking about the stock market and my watch list and how I'm changing things around on there and maybe my future buys and stuff like that. So before I get into it, I need y'all to like, comment, and subscribe for more of this content and your algorithm. I love and appreciate y'all. So let's get into it. Usually on Monday or Friday is when I normally buy. It's normally like Paycom, like $20 here and there. Just something small, nothing too crazy. So, we got a bunch of dividends coming up for the month of September. So shout out to all of y'all, T. Rowe Price, Visa, Paycom, Starbucks shareholders. Y'all are awesome. So as far as my watch list, I've been right at the top. I have like Paycom. I'm doing this off the top of my head. Paycom, I have Paychecks, which is the competitor, which I like to organize it. I kind of like to put the competitors together, or the ones that I'm really considering together at the very top. The very top of my watch list is usually saved for like the most attractive stocks that I want to own at the most attractive prices. They're usually pretty cheap, quote unquote cheap, or fairly priced. They're not the cheapest stocks in the stock market, but they're the cheapest stocks that I really want to own, that kind of line up with all of my metrics. As you know, my metrics are, like good management. I want more of a low-key manager, kind of like Mark Zuckerberg or like a Tim Cook. Not saying they have to be on that level, but just giving examples. Maybe less like Elon Musk, like as far as boastful. I really love Elon Musk and Tesla and everything, but I don't own any Tesla, and it's not enough growth in there for me. But I just like my CEO to be a little bit more quiet and like just stick to the job. So that's one thing. And then I also look for the financial metrics to line up. Very little to no debt on the balance sheet. I want more assets and liabilities. These basic stuff when you get into the stock market, you learn more assets and liabilities. No debt. And we want a decreasing outstanding share count, meaning they're buying back their shares. We want the company to be buying back their shares, but we also want them to be buying back their shares when the stock is cheap, not when the stock is expensive. Overall, we just want the share count to be going down and not up over time. A few examples of share counts going up are like REITs, real estate investment trusts. That's what REIT stands for. And, they increase shares they issue more shares out into the market, which kind of dilutes your ownership in the company. And that's not what we really want. But I don't own any REITs anymore. I used to own Realty Income, and I used to own quite a few, Main Street Capital. I used to own VG Properties, but I sold all of those because I'm more concerned about growth and less about the dividend. The dividend is a bonus, but it's also something that I look for in my stocks that I own right now. For me to find a stock that's growing at a high rate without a dividend, it would have to be growing at, I don't know, 20-30%. That's usually like small market cap stocks. They're usually very risky. So it's pros and cons to those investment strategies into the smaller cap stocks. I only have one, which is Paycom, and I don't think it's growing at that rate. It may be growing at 15% or so. Its revenue, 15-20%, something like that. It's only 9 billion market cap, so it's pretty small compared to my other positions, T. Rowe Price and Visa, which is over 100 billion in market cap. So, pros and cons. I also want the company to have a lot of free cash flow. I want the free cash flow to be able to cover their dividends and their share buybacks, as well as be able to pay their debt off if they have debt. So we love seeing like free cash flow 5, 6, 7, 8, 10, 15 billion when you get up to like the $1 trillion companies. And very very rare. Very high margin businesses. They're usually tech companies. They're usually credit card companies, which I really love, like the Visas, MasterCards, and very high margins. We want very high profit margins, so they're never really in any trouble of not being able to pay their bills or pay their expenses or pay their employees or pay down the debt, etc., etc. So we want very high, as high as possible. That's why I really love companies like Google, Meta, and those are two that I really want to own in the future. Meta has to come down maybe $50 to $100 before I consider a position in there. And Google, it only has to come down slightly. It's one of the most fairly attractive trillion-dollar companies out of the bunch. I really love that stock. Awesome company. So those are two I want to own. So I also look for, I think that's about it. Low PE ratio, price to earnings ratio, price to book ratio. We want those very low. On average, it just depends on the industry where you want your price to earnings ratio. But generally, they're like around 20. The big tech companies like the Microsofts, they're going to trade a little bit higher, like either closer to 30 or over 30. That's like the normal range for them, Microsoft, Apple. But in general, the average size companies that are growing at high rates, that pay dividends, we want those more so 20, maybe 25 at the most. But preferably really under 20. Under 20 would be nice. That's when deals start to open up in the market. And then, like I said before, it depends on the industry. Like some boring industries, like a paint company, they have not only have lower margins, but lower price to earnings because they're less in demand. People, everybody in the stock market, just about everybody, they want the big tech companies. They want the AI companies. They want these are all the pretty companies, the darlings of the stock market. Tech, AI, what else? The credit card companies, those are always go-tos. Anything dealing with that. Yeah, you want price to earnings ratio usually around or under 20 for me. And also, I want their revenue to be growing at around 10% or more, double digits. I want that. I want the dividends to be growing around double digits, 10% or more. My lowest company doing that would be, I think, T. Rowe Price, because they pay such a huge dividend. Because you got to think, T. Rowe Price is over $100 a share, and their yield is at like a 4%. That's insane. A 4% stock price over $100, no debt on the balance sheet, which I don't know how they do it. Plus, their profit margins aren't bad either. They're like 20% profit margins or something like that. So amazing company. BlackRock's also awesome. T. Rowe Price is just a little bit more attractively priced. That's why I have a position in that. But those are pretty much all the things that I look for when I'm invested in the stock. Management, price to earnings ratio, revenue growing over 10% or more. I also want growing free cash flow. Growing their earnings, growing, stuff like that. Oh, and one more thing that I look for is the return on invested capital, which is very important. I want to know that the management is investing, they're getting high returns on their capital. And also high returns on their assets. I want a high return on their assets. It's normally a little bit lower than the return on invested capital, but I want that like 5 to 10%, the return on assets, return on capital. I want that to be at least 20%. I think that's not asking for too much, having it the return on invested capital at 20% or more. Like there are companies like that comes to mind, Centers, the uniforms company, Apple, Microsoft, MasterCard, Visa, Meta, crazy return on invested capital. They have crazy, like they get very, very high returns when they invest their money back into themselves. And those are the companies you want to look for. I kind of give those a pass on certain other things if they have that. If they have high returns on invested capital, I might give them a pass on revenue growth. If they have like maybe 5 to 7% revenue growth, I won't make too big of a deal about that. If their return on invested capital is like 30, 40, 50%, I know they're going to do well. And as long as they consistently, the stock is going to continue to go up. They're going to continue to buy back shares, decreasing their share count, driving the stock price up. And investors see that and they flock towards it. So that's another thing that I look for that's very important. So I really love that. Like I said, no debt. I also want to know that it's kind of a barrier to entry into their industry. And if not, I want for them to be the best or have something that makes them stand out, like multiple products, not just one thing, not just be a one-trick pony, have one product, have multiple products, kind of have something they specialize in and that they do better than their competitors. I want their margins to be better. I want their returns to be better than their competitors. I appreciate y'all for watching to the end of the video, at this point in the video. And I hope y'all have a great rest of your day or night. Hope y'all was able to gain some value. And I'll catch you on the next one. Stay tuned. Peace.